I'm Alan Kinney, Editorial Director with REIT.com, and we're at the Wynn Las Vegas for REITWorld 2015, NAREIT's annual convention for all things REIT. I'm joined by Jim Sullivan, Managing Director with Green Street Advisors Advisory and Consulting Group. So Jim, a lot of talk about REIT spinoffs this year. What's driving the interest?
I think there are really two factors. Number one, real estate prices have never been higher. The Green Street Commercial Property Price Index concludes that real estate pricing in the United States is today on average 20% higher than it was in the '07 peak. So high prices are a primary driver. The second reason is that earnings multiples between publicly traded REITs and publicly traded operating companies are wider than they've typically been. So it's only natural that companies that are not in the real estate business but happen to own a lot of real estate are looking at their real estate value maximization opportunities, one of which is a REIT spinoff.
So lots of talk, but how much action are we really going to see?
Well, there's a lot of interesting ideas out there, and I think the decision that a company makes is very company specific. I think for some companies, doing a REIT spinoff, doing a REIT conversion will be absolutely the right path. But I think for others, more traditional real estate financing, such as a joint venture or a sale-leaseback or mortgage financing, will be right for them. And finally, I think for certain operating companies, especially those with strong balance sheets, I think a more traditional financing like the unsecured debt market, which doesn't involve the real estate at all, could be the right path for them. So I think it really depends on the company, the real estate they own, their business prospects, and what they need the capital to go out and execute.
That's the companies themselves. What about the investors? How do you see the market reacting to these spinoffs?
Yeah, well, REIT investors like simple, and they're comfortable with certain property types. So I think if the spinoffs or the conversions involve property types that are familiar, they'll be welcomed with open arms. And there I'm talking about quick serve restaurant properties, I'm talking about anchor boxes occupied by retailers. Those are very familiar. As we start creeping towards non-traditional real estate, think cell towers, transmission lines, telecom networks, there I think the onus is really on the companies to educate the REIT market, to explain the demand and the supply characteristics of those businesses, and most importantly, to help the REIT market understand how to value these things compared to, say, an office REIT or an apartment REIT or a self-storage REIT.
And what's your advice to companies that are considering spinning off?
My advice would be invest the time and understand what you have. What is your real estate? Where is it located? And very importantly, what's it worth? And are there uses other than a store or a restaurant that would create even more value on the sites that they own and control? Do the work, understand what you have, because if you don't, companies shouldn't be surprised if an activist investor comes along and makes the case to the public market that real estate value could be unlocked and create shareholder value. And that's a message when presented by an activist may or may not include precise information. So companies should control the message, and the first step to that is doing the work to understand what's our real estate, what do we have, and what's it worth.
Thanks so much for your time, Jim.
Thank you.
Be sure to visit REIT.com for more from REITWorld 2015.